Hey everybody, welcome to the second quarter of 2021. This is the Scouting Report, a quarterly screencast that we record each and every quarter to go over the state of the stock market, bond market. Many times we'll touch on commodities. Today we're going to talk a little bit about gold, gold miners, Bitcoin, different sectors, subsectors, and industry groups within the stock market. And then kind of close up shop and give a little broad overview of some things we might expect here going forward in the month of April. So without further ado, let's go ahead and get started. I always like to start with a quote, and the quote today is, it's Horace Walpole, and he said, "The world is a tragedy to those who feel, but a comedy to those who think." And the reason I like that quote right now is because there's a lot of talk and a lot of emotions running high out there now that we've seen a change in the presidency. We've seen a change in, who controls the Senate, the House of Representatives. There's obviously, no doubt, a lot of money printing going on, a lot of stimulus. And I think that what ends up happening a lot of times when we see a regime change is there ends up being a lot of fear, a lot of emotions, a lot of feeling, as opposed to really just thinking and looking at the data and paying more attention to the raw data and less attention to the things that make us feel bad or make us worry or get scared about what might be or what might become of the stock market or bond market going forward. So I think that's what the kind of the call it theme for the day. We're just going to look at the data and see what things look like. So let's look at the S&P 500 for starters. And when I look at this chart, I see an uptrend. It's obviously, there's been some choppiness here. Obviously, after the Corona crash, things dropped in early summer. They dropped again at the end of summer and kind of went sideways for a good 2-3 months. And then we had kind of a positive trend, and now this recently we just have this sideways movement where the market's kind of just barely dipped below its 50-day moving average a couple times, but that's pretty much the extent of it. Things haven't really gotten all that bad. Now, one thing that I will say has concerned me a little bit is the fact that when we look at RSI on the bottom here, so momentum, this is a momentum indicator, is as price has continued to rise, so as the market has continued to go up since, call it, this is June, we'll just say since November. The momentum indicator RSI has not been able to close above 70. And typically in a really bullish positive market, that's what we want to see. We want to see the market bottoming no lower than 30, but ideally above 40 when it comes to RSI, that is. And then we want to see it kind of closing above 70 and spending a little bit of time above 70 from time to time. And that would be kind of a bullish camp, so to speak. If it were to fall below 30, then that would be very bearish, it just wouldn't be a very good sign for the market. So that's the first thing we're looking at here. When we look at the NASDAQ, which is really what the market's been kind of moving on this past, we'll call it year, is technology stocks and the stay-at-home stocks, work-from-home stocks. And what we've seen recently is a market that did well in January and the first part of February, and then we saw a correction. The market went down about almost 11%, I believe it was, from top to bottom, just between the end of February, beginning of March. And then since call it early March, we've seen it kind of chop sideways, and right now we're finally starting to see the NASDAQ peep its head right above water here, which when I say above water, I mean above the 50-day moving average. Now, if we look back at March, you can see here in the bottom pane, this is the percentage above or below the 50-day moving average, and the worst things got so far anyway was about 5.6% below the 50-day moving average, or in other words, 5.6% below water. We can try and translate into the feet, meters, it doesn't really matter. There is no translation, but the bottom line here is we want to see the market spend as little time underwater and as much time above water, all while within a positive uptrend. When we change gears and look forward here, this is a 21-day moving average in the dotted line in the middle here, so a 21-day trend with 3% bands on either side. And this is something I've always looked at. I shouldn't say always, but I've looked at this for years. It's something I always pull up each week, each month when I'm going through my dashboard, we'll call it. And one of the things that you'll notice is when the market has a tendency to peak above this upper band, this blue band, you can see sometimes it kind of pops up and then it corrects. You see this mean reversion. And the same thing happened here where you get this bop up and then you get a drop and a mean reversion there. So whenever the market, like it is right now, gets above this upper 3% band, above its 21-day moving average, you can possibly see some upward movement for a while before it ever does any mean reversion, and then you can kind of see a big kind of swift reversion to the mean, and even call it an oversold snap, almost like a rubber band being stretched a little bit too much to the point where it snaps back. But I don't think that there's enough information here to tell us anything other than the market's maybe a little bit overbought in the very, very, call it near term. But I wouldn't say that that's any reason to be worried or any reason to start trying to figure out ways to wait for some pullback. Because as you can see, if we look back to July, it popped up here, pulled back, but barely pulled back at all. Then it popped above the 3% band again, then again. So, I mean, you can see I didn't put an arrow at every single time we crossed above it, but here from November until January, we spent, the market spent most of its time above this 21-day moving average without peaking above the upper band, but also without really mean reverting either, without pullback below the 21. So this is interesting, and when you look at the NASDAQ, when you look at the exact same thing with the NASDAQ, it's a different picture. Again, we have the same kind of pops above that upper band with mean reversion back here in June and October. But what we also have on the NASDAQ, which is kind of the tech-heavy, more growth-heavy index, is this choppy sideways movement where right here when the market popped above that upper band, it really is finally starting to get back to where it was at the beginning of the year, but generally relatively flat so far this year. If we move forward here, the next thing I want to show you is more of call it an intermediate term chart on the S&P 500. We have the 10% drop in January of 2018, February 18, and then we have a bounce, then an 8% drop in February, and then kind of a climb northward. Then we had that real fast, call it 59-day, 20% drop from September through Christmas Eve of 2019. And then we had a really, really swift recovery after Jerome Powell stated that he wasn't going to be raising interest rates anymore. And then the market kind of headed northward right up until the Corona crash. So the COVID crash was, again, as we all know, the fastest market drop in U.S. history by a long shot, 34-35% in only 22 days, and also the fastest recovery in U.S. history as well, with only 29 days. So a pretty wild ride here that we've seen this past, call it year and a half or so. But really, you could go back 3 years, and it's been an insanely choppy environment, especially, say, for a trend-following strategy. But what I'm looking at on this chart specifically, what I wanted to share with you is this intermediate term. So this is a weekly chart, and this is an intermediate term RSI, or relative strength index, or in other words, a momentum indicator. And as the market's been printing higher highs, so high here, we're seeing lower highs in momentum on RSI on a weekly basis. In fact, most recently, on this climb to new all-time highs this past several months, we haven't seen the weekly RSI number climb back above 70. And if you remember from just a few slides ago, we really need to, in order for the market to remain long-term healthy, we need for this market to eventually crack back above that 70 level, and in a perfect world, to negate this negative divergence for it to break above that descending diagonal red dotted line. So, but right now, that's something that I'm watching. With that all being said, we look at the percentage of stocks above 70. So remember, I talked about how, actually, let me go back real quick here just so I can show you what I'm talking about one more time. So remember how I said that I want to make sure that stocks we own, investments we own, like bond ETFs, anything we own, we want it to be in a bullish regime, or a bullish, call it a bullish camp. And in order for it to be in a bullish camp, we want it to ideally be trading between 30 and 100 on RSI. In a perfect world, it never really gets below 40, and that would be very, very bullish. That would be a very strong market. But so what we want to look at on this next slide, where what it's showing us is, this is a chart of the percentage of stocks on the S&P 500 with an RSI 14 above 70. And the reason why, and this is a little bit nerdy, in fact, this is about as nerdy as I'm going to get today, but for those of you who have interest, stay with me here. You can see up here over 20% of stocks on the S&P 500 back in February were trading above 70 on their RSI. So in other words, momentum was very bullish, and it was above 70. This most recent pop on the S&P 500 meant it shows us here that there were fewer stocks trading above 70 on momentum. And on this most recent pop to all-time highs just in the last couple days, you can see it's an even lower high. So the reason why that's concerning is it's showing us that not only is the momentum on the market, the major market indices themselves showing lower highs, but we're also seeing the stocks within the market, or in other words, the companies that make up the market, we're also seeing those companies print those same lower highs, and seeing now at this point 8.12% of stocks are above 70 on RSI. So that's somewhat concerning. Nothing to go running to the fences or finding a bunker, but it's definitely something we need to continue watching, because we could see some follow through to the downside. Let me clear my throat here. Speaking of, one of the things I like to watch on a day-to-day basis, and I kind of track this as I go throughout the week and throughout the month, is I want to see that when the market's up, I want the up days to be big volume days. In other words, when the market goes up on any day, ideally I want to see a lot of volume, or in other words, a lot of trading volume on those up days. Conversely, when the market's going down on any day, so whenever the market closes down on any given day, I want to see low volume, because that shows me that there's not a lot of support for lower prices. What we don't want to see is when we see a down day in the market, we don't want to see really high volume, because that indicates that there's a lot of selling pressure, a lot of selling enthusiasm. Furthermore, when the market has an up day, we don't want to see lower volume, because that would indicate that these up days may be head fakes. I don't want to say they're not real, but they don't have as much enthusiasm behind them. And that what we've been seeing this past few months. This is an indicator called on-balance volume, where it takes and calculates the volume over the course of the last several days over time. And you can see here that as the market's been going up this past year, right up until mid-February, generally speaking, the up days have been really good compared to the down days. But just most recently, this last few months, we're starting to see that decline a little bit. Now that can happen, and it's nothing to be panicked about. You can see here it declined in December, but then the market kept going up. So it can decline from February through April here, and then we could see it pop up, and we could see volume come into the market over the course of the next few days or weeks, and this whole, call it negative evidence or concerning evidence, could be completely negated. And that's why, in fact, now's a great time to share this. That's why what's most important, I can show you momentum indicators, I can show you volume indicators, but at the end of the day, the thing that's most important are price and trend indicators. In other words, is the market going up? Are we seeing higher highs and higher lows? Or is the market going down? Are we seeing lower highs and lower lows? Or another way of looking at it is comparing it to a moving average, like the 50-day moving average here, which I always like to say is below or above water. You can see here the market's up pretty high right here above that, call it watermark for the S&P 500, whereas the NASDAQ, it's not. So what we might see perhaps is a catch-up of the NASDAQ to the S&P, where the NASDAQ and the tech stocks start to catch up, or we could see the opposite, which would be the S&P kind of catching down to the NASDAQ. Or it could be both, in fact, because there's been a lot of sector rotation lately. So that's one of the things that I've been watching. But when we look at the long-term trend, and when I say long-term, I mean ultra long-term, this is a monthly chart going back several years, there was this negative divergence that I was watching going back from early 2018 through last year, and at the end of last year that negative divergence was negated. And it was negated because you can see here that RSI not only broke out above that descending trend line and momentum, but it also cracked above 70. Remember earlier we were talking about how in order for the market to be in a bullish regime, we really ideally want to see it kind of peeking its head above 70, and if it spends a ton of time above 70, great. There's nothing wrong with that. That just means that the chances are price and trend are probably continuing higher. And you can see at the upper pane here, the stock market, there's the S&P 500, of course, but the stock market here is going up as a 10-month moving average, and we're seeing kind of a nice positive trend, and I don't really see a whole lot to be concerned about right now. So when we look out further into the future, it looks pretty nice, and I really, really do like this negative divergence being cracked and broken with that breakout recently. What's concerning me again is the weekly divergence. So if I go back to it real quick here, this negative divergence on a weekly basis, or the intermediate term, what would make me happier is to see it crack back above this level, and that would mean that we have negative divergence, in other words, a negative clue or negative evidence being broken already on the monthly case, and then also on the weekly and more intermediate term case. So that would be another positive sign. Now, we were looking at monthly charts a second ago. This is a daily chart. I typically look at this at least a couple, when I say look at it, I look at this all the time, but I typically don't show this in these videos or in articles, but maybe a couple times a year. And because, I think it's important to show people that what this is and what it means and re-educate you, because it's important when it matters. When it doesn't really matter, it's kind of just redundant, but it matters right now, and here's why it matters. The upper pane is the S&P 500 index. Remember, the S&P 500 is a cap-weighted index, and what that means is that the biggest companies on the S&P carry all the weight. So if the big companies go up, it could mean that a bunch of the smaller companies underneath could be tanking, and we wouldn't be able to see it because they're so small that they don't represent enough of the weight, so therefore we don't see that price movement underneath the surface. I compare it to the generals. With my mentor Tommy Dorsey always used to say the generals are like the S&P 500 index, the NASDAQ, the Dow, and then the troops are the individual companies within those market indices. And what we want to see is when the generals are running into battle, or in other words, when the stock market is going up, the S&P is going up, we want to see the troops running into battle right there with them. What we don't want to see is we don't want to see the generals going up here running into battle and to turn around and to see a declining advanced decline line, which means that all the smaller companies are declining. In other words, the troops aren't there to help the generals, and it's going to end up being a slaughter. It's going to be a huge outnumbered battle with, call it, one or two generals up at the top there and a whole army waiting to face them on the other side of the hill. So what I want to show you here is that back in September, we had this high in the S&P back in June, and then the market corrected twice, and it finally was able to crack sustainably back above its prior June highs in November. But if you look at the advanced decline line, which is the number of stocks, the individual companies within the stock market, you can see here that that was already able to crack pretty decisively to a new high a couple months earlier. It did pull back and retest, but it continued to head to new all-time highs on a continual basis, well ahead of the S&P 500 going up. And that's a good thing. In fact, it's continuing, as you can see here, to print higher highs, higher lows, along with the stock market. And what that tells us is that not only are the generals going up, which we can all see, that on the long-term picture is good, but underneath the surface, we're also seeing those troops run right along with them, and that's a good thing. All right, losing my voice here. Let's change gears, talk about gold just briefly. Gold has been going down pretty much since last summer. It's been, there was a couple opportunities where it might have made sense to try and enter a trade back here in September, October, maybe again here in call it December, end of the year, beginning of the year. It kind of failed again. But at this point, I see lower highs, lower lows. I see a declining 50-day moving average, or in other words, a declining 50-day trend. I do see, I don't want to call this a positive momentum divergence. It is a higher low in momentum, but it's kind of almost a higher low in price as well. So I don't think that that's as strong evidence as what we're seeing in some of the other things I was showing you earlier. But if we could see gold kind of start to base sideways here and hold this 157 level on the GLD, then maybe as momentum starts to work its way out, maybe as we start to see more buyers come into the game here, gold could be a little bit more viable investment. But at least for now, there are just too many other investments that make a whole lot more sense to own than gold. Next, we have gold mining stocks. And what I find interesting here is that, when we looked at gold on the previous page, in fact, let me look at it real quick here. I want to show you one more time. Notice that RSI, again, momentum crossed below 30 here, went up, and then we just saw a higher low above 30 in momentum, okay? Now, let's look at gold miners. Gold miners never went below 30 to begin with, That's good, right? Now, it's kind of been in no man's land here. We're not seeing anything above 70 since back in July. But ever since July and this descending trend that we've seen since then, momentum has never really crossed into a real negative regime. Again, it'd be nice to see it holding above 40, and it's not. Most recently, it held above 40 just this past week. However, if we could see, and you can see it's peaking above water here, if we, just like gold, if this thing could kind of find its way sideways a little bit, build some momentum, and if we could see some high volume up days in the market, then that would be a really good sign that maybe gold miners could be more of an intermediate term to long-term investment as well. So that's gold miners. Now let's look at Bitcoin. So Bitcoin, it's a couple things I want to share with you. First of all, again, RSI momentum has never gotten below 40. Every dip that we've seen in Bitcoin recently has not crossed below 40. However, we do see this negative divergence, and that's concerning. I've been watching it for weeks now, and as this continues to head lower, that's something we're going to have to watch to see if price is going to follow it lower. So again, remember, negative divergence doesn't mean the market has to go down. It doesn't mean, in this case, Bitcoin or a stock or whatever we're looking at, because we can put this momentum indicator and a number of momentum indicators on any investment we want, any market index. But in this case, we're looking at Bitcoin. So just because this is a declining high and negative divergence in Bitcoin doesn't mean that Bitcoin has to crash. It doesn't mean it has to go down 20%. Is there a higher likelihood that it could collapse and head down, say, 10, 15, 20% as a result of this clue here that we're seeing? Yes, that's possible. But again, at the end of the day, what matters most is price and trend and volume and what the market's doing. So right now, again, we haven't seen the market close below its 50-day moving average. Even, let's see, this looks like it was, I think, 2 Fridays ago. The market still, even though this is an empty candle, which means it opened at the bottom and closed up top here, the market still closed above it, the 50-day moving average. So it still closed above this 50-day trend line. So full disclosure, we have a position in Bitcoin right now, and my exit's at about $50 a share. So if it were to fall below that level, it's a very, very tight stop, which just simply means that it's very low risk, and which gives us a high potential for reward here if it were to head northward. But right now, Bitcoin is in a positive trend until proven otherwise. Changing gears again from Bitcoin, this is a relative strength comparison chart that compares small cap stocks to commodities, to international stocks, to U.S. stocks, to money market or cash, and bonds. And you can see that the ranking is exactly how I just explained it to you. So it's the number one asset class or number one category on this chart here is small cap stocks. That's where the growth has been. So they're the leader, they're the winner right now anyway. And the number 2 winner or second place right now is commodities. Close behind, international stocks. Even closer behind international stocks is the S&P 500, so domestic stocks here in the U.S. And then, of course, if we skip money market down here, we've got bonds in the basement. So we'll talk about bonds in a second. But bonds have been a rough go lately. Let's first, before we talk about bonds, let's look at industry group sectors and kind of what the strength looks like right now in the market. This is a relative rotation graph. In the upper left-hand quadrant is if stocks are up here in ETFs or industry groups or investments are in the upper left-hand quadrant, that means that they're improving versus the market in strength. If they're in the upper right-hand quadrant, that means they're winning, they're beating the market, they're leading the market. That's good. Bottom right means they're starting to weaken versus the market, which initially is not a big deal unless it is a sustained rotation to the bottom left quadrant, which would be lagging or underperforming the market. On the left-hand side here, you can see that the only 2 investment types or sectors or industry groups that are in the, decisively I should say, in the lagging and improving quadrants are gold miners and junior gold miners, small cap gold miners. So some of the investments here circled in red are ones that we have owned, but we sold them. The ones in blue are some of the things that we currently own. So things we sold were things like cannabis stocks, solar stocks, genomics, IPOs, biotech, technology, online retail, and auto stocks. Some of the stuff that we still own are things like energy, small cap discretionaries, so small cap luxury goods, steel, energy, small cap energy, and oil, as well as blockchain. So those are some of the things we're focused on right now in terms of industry group and sector. And then if I go forward, and as I promised, I want to talk about bonds a little bit. I sent out a private letter to our clients today just explaining some things that we've been doing with bonds lately. And I do apologize for my voice here. Should have had a glass of water before I started. But you can see that since May of last year, and really the high in, we'll call it April of last year, was roughly the same high that we saw in August of last year. And since August, or April, whichever way you want to look at it, Treasury bonds, United States Treasury bonds, are down, or have been down, more than 22%, which is pretty wild. As one of our clients said today, I thought bonds were supposed to be safe. And that's true, bonds are supposed to be safe. But obviously there are times when bonds aren't safe, and there are times when it doesn't make sense to own certain types of bonds. However, what I'm seeing in the bond market right now, we've been kind of watching and waiting and paying attention to, again, an RSI, a momentum divergence in bonds, not just 20-year bonds, but 25-year bonds, 25-year treasuries, I should say, as well as shorter-term treasuries like 3 to 7-year treasuries, or 7 to 10-year treasuries. So here you can see lower lows, right? We got a low in price, so bonds went down, bottomed in March, popped a little bit, headed lower yet. But when you look at momentum, we had a low, the same low we had in late February. Then we had a higher low in March, followed by a follow through to the upside and a break above the peak you can see right here in March through April. So we haven't crossed back above the price yet from March's high, and I don't know if we will, but if we do, then that would be very positive, and it would almost be confirming, well, not almost, it would be confirming this positive evidence or this positive momentum divergence that was indicating that maybe bonds were getting ready to bottom out, and maybe they were getting a little bit too oversold. So that's what we're looking at with bonds. Now, to change gears one last time here, April going forward into next quarter, April is typically a strong month for stocks. In fact, it's the number 2 best month for the year, next to November being the number 1 month of the year for the stock market. So you tend to see kind of things do well for the first half of the month, then they kind of go sideways for a little bit on average. Doesn't mean that's what's going to happen this year, but that's what the averages say. When we look at April compared to all the other months of the year since 1950, the last 20 years, 10 years, and in post-election years, you can see that, as the title here says up top, April has been kind to stocks. So it's been a good month, generally speaking. Not to say it won't be a good month this year, because anything's possible, as we know, but the evidence is on our side from a historical and a seasonal standpoint. So I think that's a good thing. Another thing I think I want to show you here is I hesitated to put this one up because I'm colorblind, and I literally have to have someone else look at these lines and tell me what color they are. But obviously 2021's right here. Here's what the market's done so far in 2021, looking at the S&P 500. The Nasdaq's a completely different picture, by the way. The Nasdaq's about even. But if we look at all years since 1949, having nothing to do with politics, post-election years, or who's president, who won, who lost, then you can see here that it's been a pretty good year, a post-election year. We'll call it a 9% gain on average. When you look at all post-election years, though, you can see that it gets a little bit worse, and then post-election years after the incumbent party loses, not so great. So that all being said, 2%, yeah, not so great, but I guess I would take 2% over a loss, right? So we'll see what happens the rest of this year, but right now, as I mentioned earlier, we have the S&P 500 doing well, as we've seen a rotation out of the growth technology names that we saw working really, really well the last half of last year, into some kind of more open the economy type stocks. And then a lot of these stocks tend to get hit a little bit whenever there's news that comes out about additional lockdowns coming because of new strains of the coronavirus and things of that nature. So I think we're probably still going to see some of that, but I do think that eventually And as long as the Fed continues printing money and they're supporting the economy, interest rates stay low, inflation stays relatively at bay. I don't think we're going to see hyperinflation anytime soon. I think things should be okay for at least a little while here. But we could see, as the chart shows, I'll go back to this one more time. Typically in the summertime, June isn't always the best month in the world, and then August and September are the worst months for the stock market on average. So those tend to be months when the market isn't doing so hot. But looking at things right now today, this is my pre-flight checklist, as I call it, and what it is it's something that I look at every single day. It's got all kinds of indicators on it, and basically what you need to know is green is good, blue is good, red is bad. So generally speaking, we see a lot of blue and a lot of green here. It's very rarely all blue and all green, but this is telling us that things are good, at least right now in the near term. I think that the market's in a positive trend. We've got a positive trend on a short-term basis. Sorry, I'm slamming my hands on the ground here. So positive trend on a short-term basis. We've got some evidence that suggests that momentum's waning a little bit, but again, the trend is still up on an intermediate-term basis, short-term basis. There are some things that I'm going to continue watching to see if they turn into something maybe worse, but it's not anything different that we haven't seen this last several months, as the market just kind of continues to go through its normal, healthy corrective period of corrections, choppy sideways movement, and new highs. And I think that as long as the Fed is on our side, as long as interest rates remain near zero, as long as there's not some crazy geopolitical event or something that occurs, like a completely new strain of COVID that somehow ends up just as bad as the last one, where vaccines aren't working, I think that the market should probably continue to operate normally in a healthy manner, with normal pullbacks, corrections along the way. So temporary setbacks, but long-term looking pretty good, at least for the next several months. That's all I've got today. Again, I apologize for my voice. Hopefully it wasn't any issue, and everybody was able to understand me. If you have any questions, feel free to give us a call, shoot us an email. You can go to our website at libertaswealth.com. You can get access to our calendar there if you'd like to set up an intro call, or if you just have questions. You never have to be a client to ask a question, so feel free to reach out if you'd like to just get together and talk on a Zoom call or a phone call. If you would like a second opinion on your retirement plan, financial plan, estate plan, and your retirement portfolio, we offer free second opinions. There's no obligation whatsoever. So please, if you're interested in that, don't hesitate to reach out and let us know. But that's all I've got for the day. So hopefully you got something out of this today, and you're enjoying the warmer weather, at least here in Ohio, and we'll look forward to seeing you next time.